All right, let's talk about something that's all around us, shaping our world in ways we barely notice, but almost never really understand. I'm talking about interest rates. You know, they're one of the most powerful forces in your financial life, but they kind of operate in the background. So today, we're going to pull back that curtain.
Just picture that for a second. It's not some dramatic stock market crash. It's not like someone stole your money. It's just quieter. It's this invisible force, a decision made hundreds or thousands of miles away that's silently eating away at your savings, your paycheck, your future. And that feeling? That's the reality of how interest rates work.
And silent puppeteers is the absolute perfect way to describe them. They are these hidden strings that control who can afford to buy a house, who gets a business loan, who spends, who saves, and ultimately, who gets to build wealth. They're hiding in plain sight, and today we're going to follow those strings all the way back to the source.
Okay, so what are they really? I mean, most of us have a general idea, right? But to really get it, we need to go back to basics. Before we can see how the strings are being pulled, we have to understand what the strings are even made of. So let's start with the absolute core idea, the price of money.
That's it. It's really that simple. Just like there's a price for a gallon of milk, there's a price for money. The interest rate is just the cost of using someone else's money for a little while. But here's the kicker. Unlike the price of milk, the price of money is being tweaked and adjusted all the time, on purpose. And that's where things get really interesting.
And this flow shows you exactly how it works. It all starts at the very top, with one single decision. A central bank, like the Federal Reserve here in the US, sets this thing called a benchmark rate. Commercial banks, the ones you and I use, then use that rate as their baseline, and they add a little on top for their profit. And then boom, suddenly that one decision has trickled all the way down and changed the rate on your mortgage, your car loan, and even the tiny amount of interest you might earn in your savings account. It's an incredibly powerful ripple effect.
So why are the central banks doing this? Why are they constantly fiddling with the price of money? Well, think of it like they have their hand on a thermostat for the entire economy. Their big job is to keep things from getting too hot, which leads to crazy inflation, or getting too cold, which could mean a recession and job losses. So let's look at how turning this dial up or down actually changes the economic weather for all of us.
What's really fascinating here is the cause and effect. It's a series of direct trade-offs. You raise the rates and borrowing money gets more expensive. So people buy fewer cars, fewer houses, and businesses put off that big expansion. Spending slows right down. The economy cools off. But if you lower the rates, you get the exact opposite. Money is cheap. It encourages everyone to borrow and spend, which heats the economy up. The main thing to get here is that this isn't an accident. It's a deliberate tool they use to steer the whole ship.
And that leads to the biggest question of all, doesn't it? If this thermostat is so incredibly powerful, who actually has their hand on the dial? And what's guiding their decisions? Because it is definitely not as simple as just plugging some numbers into a spreadsheet. The reality is, these are deeply human and often very political decisions. Central bankers are basically walking a tightrope 24/7. They're trying to balance all these competing goals. If they lower rates to create more jobs, they risk inflation getting out of control. But if they raise rates to fight that inflation, they could cause a painful recession. The truth is, there's no perfect answer here. It's just a series of incredibly difficult choices that have massive consequences for every single one of us. And believe me, those consequences, they ripple out way beyond just your personal finances. They play out on a national, even a global scale. A tiny little shift in the interest rate can literally change the economic destiny of an entire country. You know, history gives us some pretty wild examples. Back in the 70s, the US was dealing with insane inflation. So what do? They cranked interest rates up to an eye-watering 20%. It worked, it killed inflation, but it also triggered a nasty recession. Then, flash forward to the 2000s, and they made the opposite mistake. Fearing a recession, they kept rates way too low for way too long. That cheap money fueled a massive housing bubble that, as we all know, ended in the 2008 global financial crisis. See, these aren't small mistakes. They are world-changing events.
And for governments, this is where it gets really, really tricky. So many countries today are carrying enormous amounts of debt. When interest rates go up, the cost for them to just pay the interest on that debt explodes. It's kind of like your credit card bill suddenly doubling its minimum payment. It can force a country into a trap where just paying the interest costs more than the economy is growing, squeezing out money for everything else, like roads, schools, and hospitals. Just let that sink in for a minute. Trillions. We are not talking about small amounts of money here. A tiny 0.25% change by a central bank can send literally trillions of dollars moving around the globe, redirecting the flow of capital in an instant. It's a staggering, almost unimaginable amount of financial power.
So, let's bring it all home. Let's make this invisible power visible. We've looked at the mechanics, the history, the incredible scale of it all. But what does it really mean for you, today, and for your financial future? So, what are the big takeaways here? First, remember that interest rates are simply the price of money. Second, they're used like a thermostat for the whole economy. And third, their effects ripple out from your mortgage all the way up to the entire national debt. But maybe the most important thing to get is this. It's not as simple as saying low rates are good and high rates are bad. It all depends on the situation. Understanding this is the first real step to seeing the financial world with a brand new set of eyes.
And this, right here, is the ultimate point. The strings of the puppeteer don't just move numbers on a screen. They shape our society. At their very core, interest rates are a mechanism of power. They fundamentally influence who has wealth and who doesn't, who gets ahead and who falls behind in this big economic game we're all playing.
So the next time you hear on the news that the Fed is thinking about a rate change, remember what you learned today. It's not just some boring number for financial analysts, it's a silent puppeteer, and it's pulling strings that reach all the way to you. And that kind of leaves us with one last thought, doesn't it? What else is out there, just as powerful, hiding in plain sight? Thanks for tuning in.